Today, we're jumping right into something absolutely critical for trading: risk management and position sizing.
Yeah, absolutely essential stuff.
Think of this as a shortcut, really, understanding how the pros protect their money and, actually improve their chances for the long haul.
Exactly. We're pulling insights from trading survival, master risk, and position sizing. The aim is to give you the core ideas, the fundamentals, so you can handle the markets more safely.
Right. No matter your experience level right now.
Mm-hmm.
Okay, so let's get into it. A trader's first job isn't like hitting home runs, it's survival.
It sounds basic, but it's everything. You have to stay in the game long enough for your edge, your strategy to actually pay off.
So risk management is like your shield then.
That's a great way to put it. It's the system protecting you from, well, disaster. Those losing streaks happen to everyone. Risk management stops them from being fatal to your account.
Okay, this really clear example.
Yeah.
$1,000 account, right?
Yeah, it paints a vivid picture. Imagine you risk a huge chunk, say 25%, on one trade.
That's $250 on a $1,000 account. Seems like a lot.
It is. And if you have just 4 losses in a row, which can definitely happen.
Your $1,000 is just gone.
Poof. 0. Game over.
Wow. Okay, but what's the alternative they show?
The prudent way, risking maybe 2% per trade. So $20 on that $1,000.
Okay, much smaller.
No, those same 4 losses, you're down, sure, but only to $920. You still trade them.
Still in the game.
And here's the kicker. Let's say your next 4 trades are winners, and you're aiming for twice your risk, like a 1-to-2 risk reward.
So risking $20 to make $40.
Exactly. After those 4 wins, your $920 actually grows to $1,080.
So even after 4 losses, you're profitable because you controlled the risk on the way down.
That's the aha moment.
Yeah.
Controlling risk lets you survive the losses and be there for the wins. That 2% isn't random either. Research suggests it's a sweet spot to handle losing streaks without, freaking out or killing your account.
That really makes sense. So, okay, how do we do that? How do we make sure we're only risking that small percentage?
That's position size.
That's position sizing. It's the how. It's figuring out how many shares or contracts or units to trade so that if your stop loss gets hit, you only lose that preset amount, like 1% or 2%.
So the rule is basically never risk more than 1% or 2% of your capital on one trade.
So on a $10,000 account, 1% risk is $100 max loss per trade.
And on $50,000, if you chose 2% risk, that'd be $1,000.
Correct. It scales with your account, but the percentage stays small.
And there are tools for this, right? Calculators.
Yep. Position sizing calculators are super helpful. You plug in the details, what you're trading, your account size, your risk percentage, your dollar amount, where your stop loss is.
And the contract size, stuff like that.
Exactly. And it tells you how many units to trade. Takes the guesswork out.
Okay, you mentioned stop losses there. These are non-negotiable. Absolutely non-negotiable. A stop loss is your exit plan for a losing trade. It's the point where you say, okay, my trade idea was wrong.
And you need to set it based on the chart, not just where you feel like losing money.
Crucially, yes.
Yeah.
Set it based on technical levels, support, resistance, moving averages, whatever your strategy uses. It should be placed where the reason for your trade is no longer valid, not just an arbitrary dollar amount.
Trading without one is like driving with no brakes.
Pretty much asking for trouble, a catastrophic loss waiting to happen.
Okay, so we've capped our downside. What about the potential profit side? Risk to reward ratio, the RR.
Right. RR compares how much you stand to win versus how much you're risking. A 1 to 2 RR means you're aiming to make double what you're risking.
And aim for at least 1 to 2.
Strongly recommends it, yes.
Yeah.
Because think about it with a 1 to 2 RR. You could be wrong more often than you're right, say winning only 40% of the time, and still potentially make money.
Because the wins are bigger than the losses.
Exactly. It builds that edge.
And pros measure performance using R multiples. How does that work?
It's simple, really. Your initial risk is 1R. So if you risked $100, that's 1R.
Okay.
If you make $200 profit, that's a plus 2R trade. If you lose and hit your $100 stop, that's an extra 1R trade.
Ah, I see. So it links performance directly back to the initial risk taken.
Precisely. And if you find your losses are often bigger than negative 1R, like negative 1.5R, negative 2R, something's wrong. You're probably not respecting your stops.
And the principle is, if the potential reward doesn't stack up well against the risk, maybe skip the trade.
No good RR, no trade. Simple as that.
Makes sense. But trading isn't just math, is it? There's the whole psychological battle.
Oh, huge. The mental battlefield. Fear, greed, getting overconfident after wins, revenge trading after losses, FOMO, fear of missing out. It's all there.
So how do you deal with that?
Discipline. Emotional discipline. Sticking to your trading plan, your risk rules, your stops, your profit targets, no matter what your emotions are screaming.
Having rules like daily loss limits, maybe?
Yes. Setting daily loss limits, maybe even profit goals, and crucially, learning to accept losses. They're just part of the business. They don't define you as a trader if you manage them correctly.
Right. Okay, one last thing. What about when things are going well and your account grows? How do you scale up?
Smartly. A staircase scaling method.
Staircase.
Yeah, basically increasing your position size slowly, incrementally. Get comfortable and profitable at one level before you step up to the next. Don't just double your size overnight.
So gradual growth. And maybe adjusting based on the market.
Exactly. Be dynamic. Maybe use slightly larger size on really high confidence setups, or pull back a bit when markets are choppy or you're in a drawdown. It's about being adaptable, but always controlling that risk.
Okay, so wrapping this up, the big takeaways seem to be: protect your capital first, use precise position sizing, always look for good risk reward, master your emotions, and scale up intelligently.
That really covers the foundation. These aren't just suggestions. They are what separate consistently profitable traders from those who burn out. It's about survival and then thriving.
So here's something for you, our listener, to think about. Of these key pillars, capital protection, position sizing, risk reward, mental discipline, or that smart scaling, which one could you maybe focus on refining in your own trading approach right now? Which one can make the biggest difference for you?
Good question to ponder.
Thanks for joining us on this deep dive.